Step into the metalverse, a vast, ever-evolving realm where industrial metals take shape amidst shifting prices, market trends, and supply chain forces. But what does it all mean for you? Welcome to Cup of Joe. Named in honor of our founder, Joseph T. Ryerson, we help you navigate the metalverse, one conversation at a time.
Welcome into the October episode of Cup of Joe. We're so glad you're with us today. We've got lots to get to. There's mudslides taking out copper in Indonesia. There's aluminum producers threatening to pull out of the United States. And of course, we got the government shutdown. Lots to talk about. And it all, what I'm about to say next seems trivial next to all those, but my Chicago Cubs are about an hour away from playing a game where they'll either go home or they'll go on to the next round and face the Milwaukee Brewers, who are, I think, the team of your analyst, Nick Webb. And if that's the case, we'll have to make a side bet.
That's right. That's right. We could have a little regional rivalry going here in the not-too-distant future, which would just be great.
Yeah, you could drag him on the next Cup of Joe.
Absolutely.
Wear a Cubs uniform or something like that.
You got any predictions on the Cubs-Padres game today?
Well, I'm a diehard, so I want to say they're going to win, but I'm also a realist and know that doesn't happen very often with the Cubs. So I'm going to go 4-2 win.
Okay. I like that.
4-2 win. All right.
I like the optimism.
So we'll see.
Well, don't tell my bosses, but as soon as we finish up Cup of Joe today, I may be hopping off to flip over to that game.
Yeah, same. So make it quick.
Yeah, don't tell anyone.
Yeah.
Well, a lot of people think about October as playoff baseball season. I like to think of October as a pumpkin show season. I don't know if I've ever told you this, but the third Wednesday of every October for the last 122 years, my hometown of Circleville, Ohio, has hosted the pumpkin show, which is deemed to be the greatest free show on earth. Not freak show, free show. Completely free to enter. Yeah. And our little town of like 10,000 people gets 400,000 guests coming in to check out some of the biggest pumpkins in the world's biggest pumpkin pie. And that'll be here in about 2 weeks. So October always gets me going.
Are you going to be there?
I'm planning on heading back. Yeah.
The world's biggest pumpkin pie.
Oh yeah. It's 400 pounds. Yeah.
People, did they divide it up? You get a taste of it or?
No, I think usually after 4 days of sitting out in the sun, they usually feed it to the pigs.
Yeah, you don't want to eat a pumpkin pie that's been sitting out. Okay, pumpkin fest, it's called.
Yeah. So maybe I'll come back with some photos. But fun little fact. Probably 20 years ago, my senior year of high school, I actually sang the pumpkin show song with three other gentlemen. We formed a little barbershop quartet, and we sang the pumpkin show song. Which, yes, there is a song. It's about 100 years old. I'm not going to sing it today.
Okay, all right.
Maybe another time.
There's a pumpkin, and I like the fact that it's a barbershop quartet.
No real great backstory behind that one.
That's great. That's got to live on the web somewhere, right?
Probably is. It probably is.
All right.
Yeah, maybe closed circuit television of Circleville, Ohio.
All right. Well, good deal. I don't know where to go after that.
I don't know where to segue into this, but we were originally going to have, you talked about some of the issues that are going on within the supply chain side of the metals world. We were originally going to try and get on some of our product managers to talk through these, but fortunately, unfortunately, our guests are stuck with just you and I today because they're just so tied up. I think there's a lot of turbulence going on, but that's okay. We're gonna make do. We're gonna fill in a pretty good chunk of time. I think we got a lot of good content for everybody here today.
And I want to encourage people to throw in their questions for Nick in the Q&A down there. So he'll be happy to answer any of your questions along the way. And if we get enough requests, maybe sing at the end.
Exactly. And I will say, just as a quick preview for how I think today's show is going to lay out, probably a little less on the macro side versus what we would have done previously. Mike, you obviously mentioned the fact that we're in a government shutdown period right now. We're now 2 days in. What's interesting about this time period is we're now in an era where, at least until they pass a bill to reopen the government, some of the stats and data that we typically run through is basically going to be frozen. So U.S. government data is going to cease to exist for some period of time. We don't know whether that's going to be 2 weeks or 2 months, but it's interesting times within the data proliferation of things. So we'll be a little lighter on the macro data, but I'll spend a little more time on commodities and specifically commodity forecasts. I think both our internal colleagues as well as our customers, as we sit here in contract season looking forward to 2026, we got a lot of people who are wondering, where can we hedge? Where are hedging markets relative to where expectations are sitting? Analyst expectations. So we'll give some nice data, some nice charts around that, because we're having a lot of those conversations with customers over the last few weeks.
It's an interesting point you brought up earlier today when we were discussing the show. Is some of the data you pull for this, we weren't able to because of the shutdown. So come on, you're disrupting Cup of Joe.
And not just Cup of Joe. For anybody who gets our 10 chart Tuesday, we oftentimes rely on government data, and we're going to be scratching our heads next Tuesday when we have to put out our new 10 charts. We're going to have to get a little creative with it.
Yeah, pictures of Pumpkin Fest. Here we come.
We may just pivot into pumpkin spice lattes and world's largest pumpkins for next week. That being said, as we always have to cover the legal disclosures. These are the opinions of Nick Webb and Mike Carrazzo. These are not the opinions of Ryerson. But let's go ahead and get into it. So as we often do, want to cover the global PMIs. Not a whole lot of change here on a month-over-month basis. Again, for those who are new, left to right is going to be October 2024 through the most recent data, September 2025. And the top 5 areas are going to be the key regions that we tend to focus on. The global figure: United States, Canada, Mexico, China, and then the Eurozone. And you can see, if you look up in the far top right, the PMIs are basically very moderately, just kind of mundanely in positive territory. We went from 50.9 to 50.8, basically very slow sideways growth, I would say, on a global basis. The United States, at least per the S&P global figures, are in decent territory, sitting at 52.0, slightly down month over month, but not terrible territory for these PMIs. Canada's continuing to be a bit of a weak spot as it relates to the USMCA region. It's a little better than where it would have been, let's say, 6 months ago through the end of summer, but it is still in moderately weak territory. I think there are certainly some headwinds in Canada, and we'll talk about some of those headwinds in more detail as we get into steel markets and maybe even aluminum to a degree. A bit of a bright spot. We are seeing some incremental positivity out of China, which I think is going to help really all commodities, because as we've talked about many times, when China gets a cold, or when China sneezes, the rest of the world gets a cold. When China starts to come onto the scene from a manufacturing standpoint, they have the ability to sort of be a rising tide, lifts all boats for commodities. So that's where I'll leave it on the global scene. When we look at the Institute of Supply Management, it's a little bit of a different story, just incrementally weaker. The ISM headline number came in at 49.1, but that is slightly better in terms of the amount of weakness. So it's basically slower, slightly less slowing of growth than the prior month, but it is still slowing nonetheless on a year-over-year basis. A couple items I want to point out. I'll kind of start them over on the left-hand side. New orders just kind of flip-flopped. Last month, we got a positive number of 51.4. This month, we're seeing a flip-flop back down into negative territory. So that one is just kind of teetering on either side of growth versus declining. One that I don't really want to say whether it's good or bad per se. It kind of depends on where you sit in the supply chain. But import levels for the last 6 months have been contracting at a faster pace, and I don't think that should be any real surprise. That's kind of the point of the tariffs over the last several months. The Liberation Day, the ramping up of additional IEPA, Section 232, Section 301. All of those things are meant to stymie import activity, whether it's of commoditized goods or finished manufactured goods. So again, not necessarily good or bad, kind of depends on where you sit in the supply chain there. The overall economy, though, when we consider both manufacturing and services side of the economy, 65 straight months of growth. And when we think about GDP numbers, most of the GDP estimates are still tracking around 3%. So overall, the economy is still chugging along for the time being. It's just that the manufacturing sector is really at this stage about 3 straight years almost of slight negative data points. It's not skies falling, but it's just been a really long slog of softer manufacturing activity. Now, admittedly, that is on the back of what I would probably call a gangbusters manufacturing stint from 2021 to 2022, but nonetheless, it's been very drawn out over the last 3 years.
But what, like, if you look at like, so growth is anything above 50, I should say, right?
Yep,
And then
that's right.
like,
That's
what's
right.
considered like really like the low territory, right? Is it like we're at 49, 48, 47? When do people start going, ooh, okay, that's really getting kind of low there?
Something to be concerned about.
Yeah.
Yeah, I would probably estimate that to be somewhere in like the 46, 47 range. Anything below those,
Okay.
I would say you start to get into territory where it's an uh-oh type situation. We'd probably want to take a closer look at that. And I think the reverse, because I've met with a couple of investors recently, and they sort of asked the reverse side of the question, which is, in what territory would we be not giddy necessarily, but thinking things are improving? And I would probably put that range somewhere in the 52, 53 range before I would, and I would want to see a couple months consistently of it, because as you can see, like the new orders data, last month we started to get a little optimistic, and then we flip flop back into negative territory. So I think we'd want to see a couple months of sustained momentum in either direction to get a good sign, because right now we're in this muddled territory of ISM slightly below 50, S&P Global's data points are slightly above 50. Kind of depends on who you're asking within the survey that's getting you different results. So it's a little difficult to get a whole lot of clarity on how people are feeling about the economy going into year end and going into 2026.
Yeah. Okay.
But I think that makes sense, honestly. I mean, just a quick aside, I think there's still a lot of supply chains, a lot of manufacturing companies that are still, even to this point, even though we're many months into it, still trying to wrap their head around, how should they be managing their supply chain? Should they be reshoring? Should they be looking for different suppliers? I still think there's a lot of confusion and a lot of questions around how people want to have a go forward strategy on that. So I think that's acting as certainly I don't want to necessarily say a headwind, but it's certainly not a tailwind. It's more kind of taking people to the sidelines, it seems.
I will say anecdotally, FabTech was here in Chicago, 2 weeks ago. I had a chance to go down there. Ryerson had a booth, and our Ryerson Advanced Processing team was there, and they did mention there were more than a few customers that came up, and they were discussing what to do in terms of reshoring and the supply chain. So I mean, to your point, I mean, it's definitely top of mind, and people are still really trying to figure this thing out.
Yeah, it's real, and I think it has probably slowed activity for manufactured consumption over the last several months. Now, that being said, when we look at end markets, I would say if we compare this to the last couple of months, there are probably more end markets that are in positive territory than we've seen for the last several. So that's an incremental bit of good news. And some of the end markets that we're seeing strength in are new ones as well. Previously, it had predominantly been HVAC, and it had been I think aerospace had been a very strong one. We're now seeing things like industrial machinery, ship and boat shipments kind of adding to that mix. I'll get to this slide here in a second, but motor vehicle sales are actually holding up quite well up to this point in the year. So we are adding a little bit of positivity to the mix, and I think I've got one more chart for one of the end markets that I think could give us a little bit of optimism as we look forward to 2026 on one of these end markets, and that'd be shown here in this chart. We talked about this 30 days ago on the last Cup of Joe, but I wanted to reiterate it because it is continuing to show signs of I don't want to say extreme optimism, but I would say if we assume these correlations hold up, what we're looking at here is the blue line is going to be the Dodge Momentum Index. And what the Dodge Momentum Index does is it basically goes out to construction firms and says, are you seeing work that you're bidding on being won? And are you beginning to, start these projects? And are you beginning to see rubber meet the road? And based on those survey results, we are seeing the Dodge Momentum Index at all-time highs right now. And what's interesting about the Dodge Momentum Index is it tends to lead non-residential construction spending by about 12 to 13 months. And the correlation tends to be pretty strong. It's about 90% with a 12-month lag. So what this chart is saying is if we assume these pieces of business, and I will admit probably a lot of it's data center, AI-related build-outs, utility-type build-outs, maybe some road and bridge work, assuming those things actually come to fruition, and I don't have any reason to suggest they won't if people are winning these awards, then I would expect non-res construction to see some pretty decent activity on real spending figures as we head into 2026, 2027.
Very interesting.
And then I mentioned this briefly, but this is seasonally adjusted auto sales, and we're currently sitting at 16.4 million units on an annualized basis. you can see the chart. It's been pretty steady, slightly increasing over the last several months and maybe even several years. And, admittedly, one of the factors that could be holding that up in the last bit of data, there was a $7,500 electric vehicle credit that did expire as of September 30th. There's a chance that some of this optimism may be coming from people trying to front run that, but nonetheless, these are pretty solid data points, which should help aid in aluminum demands, carbon steel demand, things like that. Now, looking at inflation, as we often do, this is looking at the core PCE. So that's going to be personal consumption expenditures, less energy, and less food. Now, why they take food, why they take energy out, I don't know. But this tends to be the Federal Reserve's favorite gauge of inflation. I think taking those two elements out takes a little bit of the volatility out. I will say that in the last 3 months, if you look at the purple area, that's goods inflation. So that's going to be things like metals, things like commodities, finished parts. We are seeing very, very small amounts of reinflation. It's nothing to hit the panic button about. It's very, very minimal as it relates to the services side of inflation. But wanted to note, that had been a headwind. That had been actually deflationary for about 24 straight months. It's slowly gone into slight inflationary territory. Certainly some of that could be related to tariffs, people reshoring, buying product that's maybe going to be incrementally more expensive than bringing in a foreign type product. But nonetheless, I wouldn't say the goods inflation is anything to panic about. But when you sum it all up with the services side of the equation, non-durable goods, we're still sitting at a core PCE of 2.9%, which is not the Fed's goal. And it doesn't look like a whole lot, but it's sort of stabilized and even ticked a little higher in the last couple months. So from the Fed's eyes, I would say this is still kind of a thorn in their side because it's just not trending the right direction that they would want it to, despite the fact they've already begun cutting interest rates. So you're probably saying, well, why are they cutting interest rates then? And I would say that's because the jobs data has gotten somewhat rapidly worse. This is just one of the data points. This is actually this particular chart is one that we will continue to get on in the next couple weeks and couple months, despite the fact that the government is shut down. And that's because this is ADP, which is automated data processing. They're a privately held company, and they're actually tracking Social Security numbers to see how the employment picture is changing. So, it's not relating to anything related to the government spitting out data. So this will be one that we'll continue to receive. And you can see it's currently sitting in negative territory, which is fairly rare air in comparison to where we've been over the last several years. We've talked about it in recent months. There have been a number of very large data revisions on jobs that have gone to the negative side. And I think all of the weakness on the labor piece of the equation is really what's got the Fed saying, all right, we need to watch this closely because this is starting to look like something we need to address. And the way they address that ultimately is with lower interest rates.
Do we have any indication manufacturing jobs? I know you had to slide back on at the beginning, but is that growing or?
And my analyst Joey told me to include this chart that actually had the breakdown of where we're seeing growth in jobs, where we're seeing weakness in jobs. And you'll just have to visualize it with me because shame on me, I didn't include it. but I told him the reason why I didn't want to include it is because it was pretty heavily negative on the area in which we live. And that's going to be manufacturing, mining, the more of the durable goods types industries. That's where a lot of the weakness has been. Things that are holding up. There aren't many areas that are holding up from a job standpoint. Admittedly, it's really just I think they categorize it as education and healthcare services, which tend to be a little bit more of a governmental type employment mechanism. So yeah. So the things that are a little more cyclical, those are the areas where we're seeing some of the worst weakness in jobs.
Got it. Okay. Shout out.
Thanks a lot for calling me out on that, Mike.
Yeah. You know what? Sorry about that.
So this is actually a chart that I came across just in the last 15 minutes, literally just before we hopped on. And I was like, you know what? I don't know if it's a perfect representation of things, but it's at least going to be fun to talk about. What this is looking at is total job openings, and this is going to be the JOLTS data. That's going to be shown in the white line. That's the number of jobs that are available just out in the United States. And if you recall, we got as high as like 12 million jobs were being sought out for. And it was basically, I think it was double the amount of people that were actually out looking for jobs. So the labor market was extremely tight during that time frame. But nonetheless, this chart goes all the way back to the early 2000s. So the white line is going to be the JOLTS jobs opening data. The red line, whether we think there should be a correlation or not, that's the S&P 500. The S&P 500 is kind of a gauge of how our economic conditions are looking at the time. It's not a perfect gauge. Sometimes you can get animal spirits and sometimes you can get froth in markets and things like that. But what you can see is over the last 25 years, there has been a relatively decent relationship between job openings and where the market ultimately is. And I think high level, that makes sense. If you've got a very healthy labor market, that generally means that the economy is doing well, generally means the stock market should be doing well. So I think the relationship overall makes some sense. But this is where I think the correlation versus causation may be, we may get some pushback on this, but that purple vertical line, that's the moment in which basically in December of 2022, ChatGPT finally launched and everybody kind of lost their minds. They said the whole world's going to change. Artificial intelligence is going to change the way we look at the world, the way we operate. And what's interesting is at that moment in time, if we just freeze that moment, you start to see the alligator jaws opening up where the labor market actually gets worse from then on. And the stock market, the representation of the economy, continues thriving. So I think a couple things to maybe unpack here would be, there is a chance that the efficiency gains caused by artificial intelligence could be causing some industries to take away jobs. I think that's certainly possible. I certainly think that there's a case to be made that the part of the economy, at least, is doing quite well within the artificial intelligence space. Things like Google, things like NVIDIA, anything related to semiconductors are doing extremely well. Anything related to data center build-outs doing extremely well. And I do think even the Fed has admitted that over the last several months, they've seen what they call a shrinking labor market, both from the supply as well as from the demand side. So that's just kind of the idea that there are just less jobs in general to be sought after and less people looking for jobs. So it's just a generally shrinking employment picture. I don't know whether this is a perfect representation, but I think there's at least some semblance of truth in the idea that the efficiency gains are causing the number of workers needed to be a little less, despite the fact that we've got stock markets at all-time highs.
And this is the slide you opted to include, not the manufacturing one. This one's a heck of a lot more depressing. But in all serious, I don't know how far this goes back. AI coming in and helping with whatever is a pretty big disruption in the market. I'm trying to think like what would be the last big disruption, right? We're talking like the industrial age, like what would be the equivalent? And I'd like to see if that convergence is, or that divergence, I guess.
Well, I'm sorry, Mike, I don't have that chart. I apologize, but I would say probably the most recent comparable would be the 1999 through 2001 tech boom. And maybe I wouldn't even frame it in that time frame. Let's call it maybe 1995 through 2002. Because at that point in time, you basically had everybody thinking they were going to be the next .com superstar. We were probably talking about billion-dollar companies instead of trillion-dollar companies, or maybe $100 million companies instead of trillion-dollar companies. But nonetheless, I think you had some of the similar rhetoric where it was anybody in the internet is going to take over the world. And I heard some interesting commentary earlier today that, it is certainly the case that some of those companies did survive and did become what analysts thought they could become, but it was much fewer than what ultimately people were thinking it was going to be. So I guess, for instance, like you think about e-commerce, everybody said, oh, you're going to buy everything online. You're going to buy everything online. Well, it turns out we do buy a lot of things online, but it's pretty much all through one company, which would be Amazon.
Ryerson.com.
Ryerson.com.
Yeah.
Shout out Ryerson.com.
Yeah.
That's right.
Oh, Amazon. That's right. Yes.
But I guess this may get a little perverse, but there are a lot of comparables taking place in the market right now that people are pointing to 2001 and 2002. Maybe things are a little frothy right now. So, and maybe we see a little bit of a correction in markets and stock markets where people just can't grow into these multi-trillion-dollar valuations. So part of this chart, as we look at it right now, could correct by way of just the S&P 500 or any of those big tech stocks just coming a little bit back down to earth. Yeah. So I think that could be a situation as well.
Interesting chart. Yep.
Well, before I depress you too much, before I hopped on this call, I actually wanted to see how well AI was doing at depicting both you and I, Mike. So I tossed in a little prompt of a couple 40-year-old gentlemen going to a Cubs game, both very slender gentlemen holding some coffee, going to Wrigley Field, just check out a baseball game here in a couple hours. And this is what we got back. So the good news is I don't think you and I are going to be replaced by ChatGPT or any of the AI methods yet, because we're just so much cooler than these two gentlemen.
Yeah. It gave me a good head of hair, or is that you? Oh, yes. They can't mimic Cup of Joe.
Yeah, so Cup of Joe's still going to be around for the duration, but unfortunately, you and I aren't yet famous enough to get picked up by these AI models to be actually depicted realistically. So we're not there yet.
That's true. Okay. Hey, like it. Good depiction.
Last but not least, as we're talking about the inflation data and the jobs picture, just given the fact that the Fed is weighing more of a prevalence on the weaker jobs picture, it's looking extremely likely like we're going to get another rate cut at the end of October. Currently, it's looking like a 25 basis point cut. That could change if we get further job losses, perhaps from the government shutdown, or just bigger deterioration in some of the ADP data, some of the private payroll data. But as we sit here right now, both October and December are pretty live meetings to have further rate cuts. So that's going to be something that could provide a little bit of a buffer to the weakening jobs picture and hopefully the somewhat weak manufacturing landscape. Now, flipping over to metals, I mentioned I have a lot to cover on each of the commodities. We'll start with steel. So as we often do, looking at U.S. steel prices relative to Europe in blue and China in orange, U.S. still continues to be at a premium. Perhaps no surprise why. We have very heavy tariffs on most other regions of the world. And if we just do the quick math, let's use Northern Europe prices, for example. If you today we're going to try and import steel from hot rolled coil from Europe, if you talk about an ex works price, basically a local price for Europe, $610, it might cost you, let's say, $90 to get it on a boat, get it over to the United States. You're at $700 at that point. You then toss on a 50% tariff on top of that. You're talking about a landed price into the United States with the duty included, with the tariffs included, somewhere in excess of $1,000, maybe well in excess of $1,000, maybe closer to like $1,100, $1,150. So there's no real incentive to go out and source foreign material unless somebody's really cutting a deal, or unless it's a specific type of steel that's not being made here more locally. And for that reason, I think we are, even though we've seen a little bit of degradation in U.S. steel prices from about 900 down to 800 where we are right now, I do think we're nearing that bottoming point. I'm not suggesting we're going to see a massive inflection higher, certainly not like we've seen in these last prior cycles. But it does feel as though we are in the process of troughing. I think one of the main reasons for that is just the fact that any foreign threat of cheaper steel is pretty hard to come by. Mm-hmm. And you can see it pretty evidently when we look at import data. This will be another theme that we'll go through here on this month's Cup of Joe's import data. We look at carbon sheet. So this is attempting to look across all sheeted products. That's going to be hot roll coil, cold roll coil, any plate in coil form. And you can see it pretty evidently over the last 12 months. Import levels have come off, and there is no doubt why. It's tariffs that are making the attractiveness of foreign steel to be less so. And so mm-hmm. People are looking more inward to get their product, even if they have to, pay a little bit more for, domestic product. It's still cheaper than a landed duty paid foreign product these days.
And even that spike in March, right, is when kind of everybody got their imports in right before it kind of went into effect, because that's the only month that really spiked this year.
Yeah, there was a little bit of spike basically pre-Liberation Day. And I would say you'll see that across a lot of the different products where people were trying to get out ahead of whatever they did or didn't know that Trump was going to be bringing to the table. So yeah, you'll see that fairly consistently. Now, one of the things that I want to speak to in terms of, and for now it's only anecdotal, but I think we'll start to see it very realistically in the data, is in the last couple of weeks, Algoma, which is a Canadian steel mill, they're about 1 million to 2 million tons of production capacity. They participated heavily in the United States market. And I would say even up until now, they still participate in the sheet and plate market for carbon in the United States. What's interesting is, in order for them to play in the United States market, in order for them to sell product successfully in the United States market, the domestic pricing that they would have to sell at before a 50% tariff was just so aggressively low. I'm talking extremely aggressively low, meaning they aren't making any money in doing so. And my understanding was that Algoma was continuing to sell in the United States just at a very aggressively low number before the tariff, so that they could maintain a foothold into the United States, because we are one of the stronger markets out there in the global economy. We also are very, very close in proximity to Sault Ste. Marie, which is where they produce steel. They, in the last 2 weeks, have announced that they are going to attempt to pull out fully from the United States market on both sheet and plate products and focus more heavily on their own domestic economy. So selling sheet, plate, maybe some other products that they may pivot into their local economy. This isn't a great representation of things, but I just pulled up a 5-year chart of Algoma's stock price. And again, I want to be respectful to Algoma because they are a supplier of Ryerson, certainly respected, and we like the team over there. But there's no doubt about it. The tariffs have put them in a pretty difficult spot where their proximity to the United States made it so that they could just ship very, very easily into the northern parts of the United States. Once those 50% tariffs went into effect, their hope, I believe, was that those tariffs were going to be fairly short-lived. They were then eventually going to have, some sort of exclusion or exemption, and they would be able to continue playing in the United States market. Well, it seems as though Carney of Canada is playing greater hardball than what they previously thought. And for that reason, they're making this move to pull out of the U.S. market. In the last 10 days or so, the Canadian government actually gave Algoma a $500 million loan as sort of a lifeline to say, we know things are really difficult. We know it's tough for your current business. Here's some cash essentially to bridge you through to either pivot into a new market or a new geography. Their stock popped for a short period of time, but you can see as we sit here right now, we're at 5-year lows. So that's really the market's way of saying they're viewing the Canadian market as a pretty tough one to pivot into. Without the U.S. help, it might be a tough go for the Canadian steel industry. Their prices are a little depressed relative, maybe a fair amount depressed relative to the U.S. market, and with Algoma shifting its production away from the United States, that's probably going to further oversupply the Canadian market. Now, the flip side to that is, what does it do for the U.S. market? Well, like I said, Algoma plays pretty heavily in sheet and plate in the northern parts of the United States. So anybody who operates in the Great Lakes region, be it Cliffs or SSAB in the plate market or Nucor Brandenburg, there's probably going to be some incremental market share for them to attempt to gain by Algoma pulling out of that market. But I think more holistically, what that move ultimately says to me is Algoma as an industry, as a company, doesn't think that there's going to be a whole lot of cooperation in the immediate term between the U.S. and Canada. So take that for what it's worth. That's my own personal take. And also, I'm showing the stock price. This is by no means investment advice. I'm not saying go long it, go short it, or anything. I'm just saying it's a pretty tough time for Algoma.
What does this all mean for an aluminum buyer right now who's maybe purchasing in U.S. and maybe in Canada?
If we were doing a read through for the aluminum markets, because ultimately Algoma is just a steel producer, they aren't playing in the aluminum market. But if we think about what I just said with regards to tensions,
I thought it was aluminum. Sorry. Yep.
Oh no, you're good. You're good. But with regards to the tensions between Canada and the United States being more stringent or more drawn out than what we previously thought, I would say that probably means, on the whole, you would expect the Midwest premium to remain more elevated for a longer period of time. Because, and we'll get to that here in a few slides in more detail. Okay. But and any ratcheting up of tensions would probably be inflationary to Midwest premiums and to aluminum in general. And the reverse would also be true. Any sort of rhetoric where if Canada were to say we're going to put up our own wall around our country for importation of aluminum steel, stainless steel, as a way to hopefully, get the U.S. to come to the negotiating table, I think those sorts of things would be incrementally bearish to to U.S. prices, but the reverse would also be true.
We got a question from the audience while we're on it. With imports falling, what's keeping the steel markets from rising faster and higher at this point?
I would say short answer would be demand. Demand is still sort of squishy. I think we touched on the end markets. Some of them are doing decently well, but it's not across the board. I think if we were to look at just overall U.S. demand for metallic products, you're probably still in the low single digits in the negative territory. So I think that's really the short answer, is just demand is not as strong as what we would have, or what you would need in order to see a rapid rise in prices. Now, as we get through a seasonally weak time, which is typically Q4 of this year, there tend to be restocking rallies, maybe some year-end buying. Those sorts of things can bring about some animal spirits. Maybe that's something that we see that jolts markets higher. But I would say that overall the demand picture is just not such that we're going to see a massive rally just yet.
Yeah, that makes sense. Okay.
But I do think that that's why we're seeing steel prices bottoming, though, at the very least. So, pulling imports out of the market, increasing domestic utilization rates, those are things that probably are going to give the U.S. mills confidence to, at the very least, keep prices stable, maybe even have some price increases here in the coming months.
Okay.
And with that, on that same note, in the last week, we have seen 2 plate mills announce price increases, both of them $60 a ton. There are some who are kind of saying maybe that's just their ability or their interest in trying to stop the decline that we've seen over the last several months. But I think admittedly, we just talked about it. Algoma did and does play in the plate markets. If they're pulling out of the U.S. plate market as well, we mentioned Nucor Brandenburg, we mentioned SSAB out of Iowa. Both of them probably have a little bit of market share that they could try and gain. And if they're going into that aggression mode of trying to win some business, or maybe they see some old friends who were maybe buying from Algoma shift to them, they're probably going to say, well, if you want it, you got to have it for a little higher price. So we've seen that in the last couple of weeks as well. We've talked about this last 2 months. I'm going to hop back onto it just real quickly. This is Chinese steel production. And the only reason why I want to keep touching on it is because, in my opinion, one of the big points of the tariffs overall, whether it's the United States or any other part of the world, and putting tariffs on China, is just because they've been overproducing for the last decade probably. And they've been driving the price down and making it very difficult for other mills to be profitable, while arguably they're being subsidized by their government. Well, this chart, and if you look at the kind of sky blue, the light blue line, that's showing, this is a seasonal chart, so it's showing versus the last 8 years. We are currently sitting at a production rate that is at an 8-year low for Chinese steel production. So, is that coincidental, or is that related to tariffs and people kind of putting up their own walls against China? I think it probably is related to their response to people being protectionist and kind of saying, no, Mas, we don't want to keep buying this very cheap steel that perhaps is being subsidized. So, and why that matters, I think I'm a very big visual learner, and this isn't a chart, but it's a graph or a visual. The left-hand side, that is the size of China's steel industry, and I would even say this is a fairly conservative estimate. I've seen estimates suggesting that they've got capabilities of producing up to 1.4 billion tons. But relative to the rest of the world, they are larger steel producers than the entire rest of the world combined. So again, when we think about that phrase I brought up, where when China gets a cold, or when China sneezes, everybody else gets a cold, this is sort of what that is. If China's steel prices are at $430 a ton, there's no way you can't ignore that. You can put up walls as much as you want, but unless everybody in the entire world puts up their own walls against China, at some point somebody's going to want cheap commodities. And so those things still seep out in the economy. China obviously still has friends that they can sell to that don't have tariffs on them. But I thought this relative, just visualization gave a really good visual as to why people are taking such a firm approach to China's overproduction.
I wouldn't have had India in the number 2 spot if you had asked me to put me on the spot.
No, I mean, they've certainly made a lot of investments over the last 10 years. Perhaps not coincidentally, their PMIs are and have been the strongest that we've seen over the last 3 years. They're also, them in China, they're the world's biggest population. So from a steel per capita usage, they're actually probably much, much lower than where China is and has been So they probably have a lot of room to grow. They probably aren't going to grow quite at that rate just because they are seeing and have seen what's happened to China and the way in which people are kind of demonizing them for their overproduction. But yeah, they're a massive country and certainly growing into their own. Switching over to stainless, not a whole lot new to suggest here on the nickel chart, which is going to be a good proxy of where we're seeing stainless steel surcharges. We're still hovering right around $7 a pound. The good news, or for those who like stability, we've had a whole lot of stability for really the balance of 2025, right around $7 a pound, which means stable surcharges for the most part. We've talked about this in the past, but when we look at the nickel mining cost curve, that is the cost to extract nickel out of the ground, this is S&P Global's estimate of where all of the global suppliers currently sit. And I've drawn in this horizontal red line and this vertical red line, and I won't go into too much detail on this, but ultimately at $7 a pound, which is where that the red line is. Essentially what this chart is saying is anybody over here to the right-hand side is not able to be profitable by mining nickel out of the ground. Just eyeballing it, this chart's kind of saying it's somewhere around 25 to 30% of the industry is unprofitable. I've seen some analysts, and I tend to subscribe to this. I've seen some analysts suggest that it's closer to about 40 or 50% of the mining industry that is currently unprofitable. Whether it's 30, whether it's 40, whether it's 50, the point of this is to say there is a price level at which you get so low that miners are going to start rationalizing production. They're going to start saying it doesn't make sense to run this business. We're going to turn off capacity. And I would say to a small degree, we're seeing that within Indonesia, where Indonesia is starting to crack down on illegal mining, where maybe they're mining in forests that they shouldn't be doing it in. They don't have certain permits. So we are seeing small bits of crackdowns, but nothing on a grand scale just yet that would say that the supply-demand balances have shifted enough to say that we're going to see massively higher prices. But when we look at forecasts for nickel, the dark blue line here in the middle, that's going to be the median forecast of all of the banks who forecast nickel prices. You can see that as we look out to 2026, there is an expectation of slightly higher prices, not massively higher prices, but slightly higher prices from here. Even the most bearish estimates, which would be shown in the purple line, are 25 cents lower than where we are right now. So the point of this slide, and I tend to agree with it, which is I think if I were to put a skew or kind of a risk reward on, does it make sense to look at hedging? Does it make sense to taking a position in something like stainless or nickel? I think the risk reward looks somewhat attractive within the nickel markets. Again, that's Nick Webb's personal opinion, not Ryerson's opinion. But for anybody who's thinking about hedging, fixing out stainless steel surcharges for next year, just given the fact that cost curves are so close to where we're currently pricing, just a little bit of rationalization on the production side could be what the market needs to start to move a bit higher.
The LME's been quiet. I mean, remember last year, it was like a monthly thing. There was something new going on, right? On the nickel side, at least, right? And then there was even talk of like some competing exchange coming out, right?
Yeah, that's right.
Realize?
No, I haven't heard anything about it. I haven't heard about many suppliers or many customers wanting to switch indices and go to a different exchange. My personal opinion, I think the London Metal Exchange it's one of those things where quiet is good, no news is good news for them. Because I think they had some very turbulent, maybe a couple of years where their solvency, their legitimacy was kind of questioned. So I think calmness for them is probably a welcome change, honestly.
Yeah. It's either really high or really low, right?
In terms of news flow, that's right.
Yeah.
I mentioned we were going to talk about imports of other products. This is stainless steel imports over the last year. What I would say is different about stainless steel versus carbon steel is we really haven't seen much of a drop-off in stainless imports. You will notice over on the far right-hand side, these last couple of months, we have seen a drop-off. I want to make the caveat that is just based on license data. It's not actual census data, which is shown in the light blue. Oftentimes, the license data tends to be a little less reliable, I guess is how I would say it. So take those with a little bit of a grain of salt, the last 2 months being significantly lower. But you look over the last 12 months, since tariffs have been implemented, there really hasn't been too much movement in the importation of stainless steel. And I think one of the big reasons for that is just because stainless steel from foreign suppliers is still competitive. And I think in certain spots, it can still make sense to bring in stainless steel from foreign sources, not all sources, and it's probably less than it had been, say, 6 or 8 months ago. But in some pockets, some geographies, they're still coming, and I think this chart certainly depicts that. And yeah, so and part of that is going to be based on the fact that U.S. suppliers, so North American Stainless and Outokumpu, have increased prices somewhat aggressively in the last couple months. And all that does is it kind of kept the import arb, or in other words, the gap between foreign pricing and domestic pricing. It's kept it somewhat open to keep bringing imports in.
Do you mind clarifying what you mean by license data?
Yeah, so that's going to be just, people filing for permits to bring in products. It's not actually going to be checked at the border of actual tons. So it tends to be less reliable. It can get rerouted to other locations. So it tends to skew the data a little bit.
Okay, gotcha. Thank you.
Switching over to aluminum, this is going to look very similar to where we were last month, but ultimately this is the London Metal Exchange price in the white and the Midwest transaction price in the blue, which that is going to be the LME price plus Midwest premiums, which is the premium to get into the U.S. They had been correlated for a number of years. Spread was, let's say, 15 to 20 cents. Since the Trump administration has gotten into office, we've seen that spread blow out massively, and that's solely based on tariffs. The 50% tariff being tacked on to the $1.22 aluminum, that's got premiums right now sitting on either side of 75 cents. So it's much the same as where we were about a month ago, but those premium numbers are record high levels. And there was a question earlier about what is contention between Canada and Mexico, or Canada and the United States mean? Well, it most likely means a continuation or an extension of how long we see these premiums up at these levels. Now, I guess on the London Metal Exchange side, we are having a lot of conversations with customers of maybe it makes more sense to look at hedging out just the LME portion and then leave the Midwest premium floating. It's not a terrible thought. We're in a range right now on the LME that we've been in and we've seen for the last several years. We are at the higher end of it. So it may not be the perfect time to consider hedging, but it's still within a range. It's still, it's all things being equal compared to other markets that we play in. It has been a more range-bound commodity. The London Metal Exchange price has. The Midwest premium has not been range-bound. It's done nothing but take prices up pretty close to record highs, which would have been seen back in early 2022. Now, what's interesting is, unlike the steel tariffs, which I would say has led to imports falling off to a large degree because we have domestic supply capacity, aluminum tends to be getting a little bit of a different reception from the market. And what I say by that, or why I say that, is these are just a couple snippets from Alcoa, which is actually on the producing side of the equation. And they are kind of calling out the administration, saying these tariffs are not going to incentivize additional smelting capacity to make our own ingot here in the United States. The costs of aluminum that we would need in order to do so, just given the fact that we have higher labor, higher energy costs, higher alumina costs, would be extravagantly high aluminum prices. So Alcoa is of the opinion that there really isn't any benefit for most of the producers to even put these in place in the first place. And I'll give you a quick example. Aluminum Dynamics, which is Steel Dynamics' new aluminum mill that is beginning to roll some coils down in Texas, they are not a smelter. They will be producing more finished aluminum into the U.S. market, but that investment does not have a smelter affiliated with it. They are going to have to go out to the open market and buy aluminum ingots, probably from someplace outside the United States, and produce their aluminum in that way, which means they are going to be subject to the Midwest premium themselves. So all that's happened is their own cost has gone up by 50 cents, 60 cents a pound, but they're just going to pass that through to the consumers. It really doesn't change. These tariffs don't really change, in my opinion, their own margin profile, their own profit profile. So yes, there has been investment in adding new finished, rolling capacity into the United States, but in terms of adding smelting capacity, which was, in my opinion, kind of the point of why they were put in place in the first place, it doesn't appear as though the industry thinks that's going to happen. So I think that's an interesting caveat between the steel tariffs and the aluminum tariffs. And over here on the right-hand side, you can kind of see where the United States sits. We'd be the green cube or diamond, you can see where our cost structures sit relative to the rest of the world. And our costs are pretty exorbitant, particularly when you look at alumina, you look at, our energy costs are basically midway up the range. I saw some suggestions that in order for a U.S. producer to be incentivized to build a smelter here in the U.S., they would need aluminum prices of like $4,400 a ton, which is, roughly $2.20 a pound, which is that's basically 50% higher than where we are, or almost double where we are.
So whereas if I can kind of feed that back to you, right? So
Yeah.
in tariffs, like steel would encourage maybe more obviously domestic production, whereas with aluminum, that's just not realistic due to the cost, right? To open new smelting capacity here in the United States, and if they do that, they're just going to they can't even get the ingot to produce aluminum. They'd have to then add that on to the end customer. So they're actually could have a pretty detrimental effect to aluminum.
Yeah, well, at the very least, it's inflationary. I would say that the key difference would be there have been investments on the steel production side that have the ability to absorb most imports coming to the United States. That if everybody just snap our fingers, everybody decides to purchase steel from domestic suppliers, not everybody's going to be able to, because there are certain grades that aren't produced or they don't want to produce here in the United States. But for the most part, the U.S. capacity has the ability to absorb large quantities of that supply chain. On the aluminum side, we don't. If U.S. consumers said we want melted, poured, smelted in the United States, there is not that capacity. That capacity will not turn on, and it won't turn on unless we were to see a very long spat of much higher prices. And when I say much higher, probably about double where we are right now. So yeah, there is a very different dynamic going on in aluminum. And honestly, based on some of these articles, it seems like some of the aluminum suppliers are even almost upset about it. And what's interesting is when we look at aluminum ingot imports, some of the players on the production side have actually gotten so frustrated with tariffs that they're beginning to divert ingot units away from the United States. So they're actually saying, because of these tariffs, it makes more sense for us to take our aluminum ingot that we smelted up in Canada and ship it somewhere away from the United States. And you can sort of see that here in this data, where yes, the import levels have come down of aluminum, but in many cases, this dark green section, that's going to be unwrought aluminum, which is another way of saying most likely aluminum ingot. And so even though there was a large inflow of aluminum between January and March, that has kind of reversed course, but I would say not for the good reasons, not for the right reasons. And I believe that's a lot of people like a Rio Tinto, actually saying, well, with these tariffs, it makes sense for us to ship it into Europe or ship it into the Middle East or something like that. So aluminum's a bit of a tricky one, in my opinion. Now, on the forecast side, I would say current pricing, if we look at futures in the light blue line and we compare that to where the dark blue line, which is the median forecast, futures are basically right around where the forecasts are. So there isn't massive, there isn't really a massive risk reward one way or the other, but I would say pricing is around within about 5 to 10 cents of where forecasts are for next year. So maybe it's not a no-brainer to consider hedging. Maybe it's, maybe not the perfect time to consider hedging, but we're at least within range of where the current forecasts are for LME, which is right around $1.15 to $1.20. And I think personally that seems to me to be a healthy range. It's a decently balanced market globally. But yeah, I'll leave that there for now.
Got a question from the audience, if you don't mind.
Yeah.
It's asking, why are aluminum prices in the U.S. so impacted by Midwest premium if so much of the input into aluminum product is scrap? Is most scrap also purchased outside the U.S. as well?
Well, I would say the short answer is just because scrap is going to be priced off of the Midwest transaction price. So even though it's not per se getting subjected to tariffs, whether we like it or not, a lot of the players who buy and sell scrap price it off of an index linked to the Midwest transaction price. So I know that sounds perverse. I know that sounds like it doesn't make a ton of sense, but that is how the industry has been working. So anybody who's buying scrap, they actually are in many ways paying the premium, paying the tariff embedded within that price, if that makes sense.
Yeah. Another question's asking any news regarding aluminum allocations.
Great question and great transition. Whoever saw my slide prematurely. Yeah. So over the last 2-3 weeks, Novelis, which is an aluminum mill here in the United States, and they have operations in Canada as well. Their Oswego, New York facility, which you can see in this photo, they're going to be right along the lake in New York. Their Oswego plant had a pretty massive fire. Fortunately, none of their, I think it's a little over 1,000 workers worked there. Nobody was injured. Nobody was killed. So knock on wood there. As I understand it, all of the workers are now back in the facility, but the fire was large enough that it did cause some somewhat lasting impacts to their production capacity. My understanding is that it could last upwards of about 4 months for them to get back to normal operating capacity. And it's one of those things where, the timing is just very difficult because we're obviously in contract season. I mentioned the fact that automotive demand is actually holding up decently well. This facility itself, you can see in this black blurb over here on the right-hand side, that facility supplies about 40% of the US and Canada auto market. So auto body sheet supply. And so, if production gets knocked out for a bit, those tier one automotive players aren't just going to sit idly by and say, oh, no worries, we'll just not make any cars this month. Well, they're still going to want to make cars. So more likely than not, over the next couple months, they're probably going to shift their supply chains to somebody else who can make that. Maybe in the area, maybe in Canada, wherever it may be. They're probably going to try and reroute some of those supply chains. And whether it's a tier one auto player or a canning company, which those are big consumers off of the production line here at Oswego as well. The shifting of those supply chains does potentially have the ability to put the market into allocation. And allocation ultimately means you kind of have to wait in line and you have to kind of beg and plead for your aluminum. The good news for Ryerson is that we should, and we have confidence that we do have contracts with enough of the aluminum supply chains here in the United States that we don't think it should have a massive impact on us. But, you combine this with the fact that people are trying to reshore their supply chains. We're in contract season. It is causing some short-term disruptions that could put us in an allocation type situation for a period of time.
Okay.
I have not heard that that's been officially confirmed, but there are certainly rumblings that could take place. And as Mike loves, last but not least, copper markets. And we've copper's been a market that you can see over the last 5 years. The charts look much different than most of the industrial metals. Nickel, we see prices currently down 70% from the all-time highs. You've got aluminum, LME aluminum still down, let's say 40% or so from record highs. Copper's still within sneezing distance of record highs as we sit here today, and really for the last 5 years it's had some peaks and valleys, but for the most part it's trended higher. It's a tight market. Anytime you hear about it, artificial intelligence, building out the grid, anything related to data centers, think copper demand. It's a very well in demand market, not just in the United States, Europe, but in China as well. And the investment, many believe, is not up to snuff to fit some of the demand forecasts for building out the electrical grid, building out these data centers. And so the market's admittedly pretty tight. It has been tight. And what's not helping the situation is this. And this one is a pretty tragic situation, but this took place in Indonesia in the last couple of weeks. This is the Freeport-McMoRan Grasberg mine. So Grasberg it's in Papua, Indonesia. You can see it's a very, very large open pit mine. And I believe this photo actually shows what happened, which was a massive, massive mud rush. If you think about a mud rush, think about like an avalanche essentially of very heavy mud. I believe it was 800,000 tons of mud fell into this pit. And I mean, honestly, thankfully only, it sounds like about 7 people lost their lives. But still very tragic nonetheless. This mine itself is one of the largest in the world. I believe it's the number 2 currently in the world. And this collapse, this destruction of this facility, I mean, you can see just visually a lot of these little indentations in the walls. That's how the vehicles get in and out of the pit itself. And it's really going to disrupt supply for quite some time. The expectation is they don't get fully back up and running until 2027. And what that means for fundamentals of copper is that's just going to further tighten the availability of copper coming out of one of the biggest mines in the world. So that mine, to my understanding, represents about 3 to 4% of global supply. And that's in a market that was already pretty tight, I would say. So we are seeing copper prices moving back higher. Everything I'm seeing is suggesting that we probably will see copper prices move north of $5 per pound, and perhaps even higher if this turns out to be a more long-term thing that they have to fix in the coming months.
Wow.
And with that, obviously a somber note for sure, but what I'll say, I do have to probably give a caveat on these forecasts, because many of these bank analyst forecasts were likely prior to that incident happening. So even though it's currently showing a median forecast of around $4.50 for all of next year, my guess is if we refresh this in a month or so, and maybe we should on the next Cup of Joe, more likely than not, we'll see these forecasts be revised higher, somewhere closer to $5 a pound, $5.25 a pound, something a bit higher than where we are, just because this does have a meaningful impact on the availability of copper around the world. So again, I apologize that we're leaving this off on a somewhat somber note, but we want to make sure that all of our colleagues and customers are informed of what's going on in the space.
Yeah. Tragic. That's terrible news. Wow. Well, we got a few questions, if you wouldn't mind.
I would love to.
Somebody asked, this is back to earlier when you were talking about the U.S.-Canada issues, particularly on the steel front. Is it going to have any impact on Stelco Cliffs?
Yeah, in a way, for sure. My analyst and I were actually talking about this morning. The market's so yes, it will impact them to the extent that if Stelco operates within Canada, but can and does have the ability to ship down to the United States. To the extent those tariffs are in place, Stelco's ability to competitively supply steel into the United States is lessened. There's no doubt about that. Mm-hmm. My personal opinion would be that Stelco probably has a little better position within the Canadian market for two reasons. One is they are not in the process of repositioning their supply chains from U.S. back into Canada, so they already have an existing customer base to a large degree. The other thing that they have arguably is they have a captive iron ore supply chain that is, from what I understand, a pretty advantageous pricing. They have an iron ore contract, I believe, currently with U.S. Steel that is at pretty attractive prices. They also, Cliffs owns their own iron ore mines, which basically makes them vertically integrated, which kind of makes it so it's one pocket to the other within the company. So I think their ability to compete at lower prices in a more competitive market probably makes them a little better off. I don't know if that was, I'm kind of answering in terms of like market competitiveness and strategy. I think Stelco is going to have some of the same hurdles, but I think they're probably incrementally better positioned than Algoma. And then Algoma will be moving back into that market.
Yeah, without a doubt, it'll have an impact to some degree.
Yeah.
And this last question, actually another one just popped up, if you don't mind. As soon as I say last but not least, another question this goes to show you probably shouldn't take slides out of your deck. They're asking for projections on steel futures. You normally have that in there. Any insight on the futures right now?
I try and change up these charts to keep it fresh, to keep it exciting, and pull something out and everybody loses their minds. So steel futures, and actually I do kind of have one. And that was admittedly why I did pull this out. Let me share my screen real quick because I'll point it out more directly. You able to see my screen, Mike?
Yes.
Okay, cool. So you'll be able to see it here within this tab here. Let me bring the visual up a little bigger. So the light blue line here, that is actually the futures curve for hot roll coil right now. So as we look out through the course of 2026, yes, there is a slight premium between where futures are currently pricing and where most analysts think we're actually going to see pricing. It's one of those things that the futures curve on any given day may not be right, but it's the market's best guess of where they think the fair value of steel should be trading. So again, I just eyeballing, it's right around 875, 880 for the balance of 2026. Is that going to be a good number or a bad number? There are going to be a lot of factors that are going to impact that. The more that people onshore, that could cause a little higher floor for domestic prices. The more you see somebody like Algoma pull out of the U.S. market, that could inflate prices a bit further. Again, I hate to bring up these types of dire situations, but, should you see maintenance issues or outage issues for, fires, things like that, those sorts of things can short-term tighten up the markets. But as we sit right now, I'll just high level say it's right around 875, 880 for next year.
Sure. All right. And then someone's asking, is there a resource for a more or less a carbon steel index for Canadian prices to be sold into Canada? Does something like that exist?
It's actually a really good question. And I don't know off the top of my head that anybody has one. Okay. I will say anecdotally, based on my reading, based on my research, my understanding is that, kind of the equivalent CRU, basically the broad market spot index right now is somewhere right around $600 a ton. Okay. Which, as we talked about, it's basically right where European prices are trading. That is about $200 less than where U.S. prices are trading. But it's a pretty well supplied market and one that probably is having weaker demand conditions than the rest of North America.
Yeah. Okay.
But I'm not aware of a specific index. There's a chance if they're trying to spitball and seek out some options, there's a chance CRU puts something out. There's a chance that Argus puts something out. But those would be my only thoughts. I haven't seen any official indexes.
Yeah. Another attendee says there is not one. So ask the answer. Thank you, Anonymous.
Great. Teamwork makes the dream work.
Yeah, exactly. And then this one came in right when you were talking about the pumpkin song, but I didn't want to take you off track. Scott, who I think is in that area too, he's asking if you've ever climbed the world's largest pumpkin water tower in Circleville.
That's a great question. Yeah, there's one of the landmarks in my hometown. When you get really bored, you go out driving around, and I think we're even a big cruising capital of the country. But when you find yourself in the middle of nowhere, we do have a pumpkin tower that looks like it's painted, orange and green on the top like oval section of it. I have never been to the top of it, but I think I need to make that a bucket list goal for the next 12 months.
Yeah, maybe climb to the top and jump into the world's largest pumpkin pie.
I might get arrested, so I might need a little legal help from our internal legal eagles. But if I'm able to get up there, I will for sure take a photo, and we'll have it on a subsequent Cup of Joe. That's a pretty good challenge.
Yeah, and the person who asked it said he's in too. So we'll connect you after the show.
Perfect.
All right. Great stuff, as always. We went a little over. We apologize, but some great questions. Nick, any closing thoughts for the group?
No, it'll be something similar to last month, which is we're very much so in the thick of contract season. Whether you're internal to Ryerson or you're a customer of ours, you want to talk markets, you want to talk market conditions, you want to talk hedging, get in touch with me and my team. We're happy to have these conversations. We will, we'll get as in depth as you want to get, and we enjoy doing so. So. Thanks for joining us. Hope you like the content, and sorry for being such a blabbermouth today.
No, it's great. It's we appreciate everyone taking their time. There's a lot of places you can be, but we appreciate you spending some time with us, and we will see you on the next Cup of Joe. Go Cubs.
You sound like a flight attendant from Southwest.
Do I? Yeah. I don't want to be that.
Thank you, everyone.
Thanks, Giles. This way. Goodbye.
See ya.